if you're selling something and you want to defer up to 100% of the taxes, you want to watch this video about tax-deferred business trusts. So you would use this anytime you have a gain that's over 100,000. So any asset, it could be stocks, bonds, mutual funds, crypto, it could be a house, it could be whatever. If you have an asset that you own and you are gonna have capital treatment, you can use this. The other time you can use this is if you're selling business ownership. So anytime you're doing a stock, membership interest, partnership interest sale, all of these will qualify under a tax-deferred business trust. So that is when you're gonna use it, and that's the whole purpose of what these do, is they help mitigate the tax through stopping what's called constructive receipt. That means the money doesn't go into your personal accounts that you control. Business account, personal account, it puts it into a different account, and so therefore you can reinvest the money and do something different. So let's talk about why very, very wealthy people use these business trusts. So there's a couple of reasons. Like I said, it can defer up to 100% of the income tax that you would owe. So that's federal and state income tax. The other thing is it allows you to rebalance your portfolio. So I get a lot of real estate investors who call me and they're like, man, I have like 400 million in real estate and I'm completely overbalanced. All of my assets are in real estate. I want to rebalance into safe assets and other investments like oil and gas. So what they'll do is they will use this trust and then they will rebalance inside the trust. So instead of doing a 1031 where your property has to keep going up, it replaces the 1031. It now allows you to defer 100% and reinvest into other assets, or starting a business, franchise, doesn't matter. Whatever you want to put the money into, you're allowed to put the money into, life insurance. And then the third is this also works as a replacement for estate planning. So if you have over 15 million, 10 to 15 million net worth, and you are going to have a large transaction that's going to give you another new tranche of more than 15 million, for estate planning, we want to separate your trusts out so that you have one that's going to be 15 million, no more, and one that's going to be 15 million because that is the limit at the time. So we want them underneath so that they can grow over time up until the day you die, and then it'll go into the estate plan. So this kind of doubles as an irrevocable trust. Once you hit $10 million, you should start looking at irrevocable trusts. And especially if you're making more money, you want to start putting money away. So this is also a replacement. So if you need tax planning, or you need estate planning and tax planning, this kind of is a double benefit. So I always tell people this is super helpful and does a double down on one transaction. So we can have a new estate plan set up. We can get up to 100% of it tax deferred, depending on how much you need, up to you. And so how do we do this? Let's talk about this. You're going to have 3 team members. And these team members are super important because they're going to help you through the journey, and they're going to give you a lot of benefits. So they're all licensed. So you're getting 3 different layers of licensure review. They're different licenses, which is super important. The other piece is each one of those licenses carries a fiduciary obligation. So you have to review everything and you have to check everything. And so therefore you each independently under your licenses have different fiduciary obligations. And so you are working and performing under that. And then lastly, because they're all independent, they have no conflicts. So they are working for each and every one of them are working for themselves. They're not coming together to coordinate an effort other than to get the transaction done and to get it done legally correct. So if anything at any point between any of the 3 people becomes a problem, they will raise their hands and they will have a conversation, and they will have to redo everything or change it to get it to be completely clearing the review of the 3 levels. So who are your 3 team members? The third one is what we call a registered investment advisor. So this is a wealth manager. They have one of the highest independent requirements for licensure with the SEC. The second person is a tax attorney. So they understand legal entity law, they understand contract law, they understand taxes, they need to have an LLM in tax in order to be a tax attorney. And then thirdly, the first person that you're going to use is a trustee. The trustee is the person who's going to manage the money on your behalf. They are the one that you are paying to help you keep this outside of your control. So they're the ones who you would talk to if you need money, and they're the ones who are going to get that moving in the right direction. So these are the three parties. You have a trustee, an attorney, and a registered investment advisor. So again, licensed with the SEC, licensed with the Attorney General, Bar Association, and they're licensed with their own trustee licensing. So these are all different authorities, all different rules and requirements. So let's talk about how this goes down. So you know who's involved. I guess this is more the who, and then we'll dive into the how. So we're gonna have a little buddy here. It's gonna be you. Little buddy is gonna be like, oh man, I need a team of people to help me mitigate my taxes because I don't want to pay this big bill and I don't want to be all involved in one asset. So he's going to be like, what am I going to do? So he's going to be thinking about, how do I find this team of three people, right? We got our three little amigos. So we're going to have the little wealth advisor guy over here. He's managing the investment and making sure it's legal. We got your little tax attorney on your team. And we got your little trustee. So you're thinking about, how do I get this done? Where do I find these people? Who's a tax planner that knows how to do this? And this is where you're gonna be like, what do I do? You're not happy. So why is he not happy? He's not happy because he is going to sell, we're gonna put it in green because money is green. He's gonna sell a house. Say it's a mansion. Lots of money. And he has 100% ownership. And he's like, okay, what am I gonna do? The first thing I'm gonna do is I'm gonna list this for sale. He wants to get rid of it, so you have to put it on the open market. So step one, he's going to list for sale. If you wanna list your business, put it on broker with a broker, however you want to do it. If you're doing stocks, things where you control the account, you don't have to list it for sale yet. You can do this in a different way, but typically if it's a big asset, you're going to list it for sale. If it's something like an investment, you would want to wait on this one. But typically here, you're going to have this go down. Then you're going to get a little, we're going to label this third party person. Third-party person is going to enter into a contract with you. So we're going to use blue for lawyer. They're going to give you a purchase sale agreement, a PSA, and you're going to negotiate, counteroffer, and until you hit the PSA point, they're going to give you that offer. You're going to enter into a contract. On this contract, there is a dollar amount, and we're going to use this little pen. So in here, there's a dollar amount. Now we know we have a party, we have a binding contract, and we know how much they're gonna sell for. So now he's gonna call his little team. His team, Mr. Attorney, is going to set up a business trust. So what is a business trust? A business trust, let's note this down. A business trust for legal purposes, this is an irrevocable trust. For tax purposes, it is a C Corp. A C corporation for tax purposes, no elections, nothing. You want to leave it a C Corp. So he's going to set this up for you. He's going to do all the formation documents with the right Secretary of State, the right state, and all of that. Then what you're going to do is you're going to do a seller financing note. And you're going to put this PSA dollar amount on here. So the note amount is going to be the equivalent. So So your money is going to be the same in the seller financing note. Then the house is now going to be owned over here. So he no longer owns it. This is going to go away because he's going to sell it with a financing note in return. So then from here, the attorney is going to do one more contract, and that is an amendment, PSA, to move the ownership from here over to here. So now this trust owns it. This guy agrees he's going to interact with the trust, and the trust is going to sell it. Nothing else in the contract changes. Same price, same everything. And that's effectively how you defer everything. You've got the trustee that steps in, manages the cash. You got the RIA guy who does all the investments, and the attorney makes sure the transaction is executed according to tax rules, state law, and binding contracts. So everything gets done properly. And this is how you defer up to 100% in taxes. For tax purposes, the treatment, let's talk about this. This is not a monetary installment note. This is not a deferred sales trust. This is just a business trust that you use. This is used by millions of people. For tax purposes, this is simply a Section 453 installment sale. That's it. It's pretty simple. You file one form. You only pay tax when it goes into your personal bank account, when the money comes out of the trust. So you don't lose the access to the money. The money is yours. It's just sitting in a trust for you, and somebody's managing it. You can invest it in real estate. It can be a limited partner in a syndication. It can buy crypto. It can buy stocks, bonds, mutual funds. It can buy life insurance. It can buy a business. It can do whatever you want in there and make you more money at a 21% tax rate.